welcome to Griffonomics.
Glad to be here for this one.
So every single year, $40 billion just silently vanishes from the American healthcare system.
Yeah, it's a staggering number when you really sit down and look at it.
Right, and it isn't stolen. It's not lost in some catastrophic accounting fraud or anything like that. It is simply taken back in this invisible hyperscale war of delayed audits, retroactive denials, and just completely opaque reconciliation files.
Exactly. I mean, we are looking at a transactional landscape that is effectively a labyrinth.
A total maze.
Yeah, a maze of overlapping codes, contradicting payer policies, and digital entities just fighting over dollars long after the patient has, gone home and healed.
And the sheer friction in that system represents one of the largest pools of administrative waste in the global economy, honestly.
Oh, absolutely. Getting paid in American healthcare is not a discrete event. It's not like swiping a credit card at a coffee shop.
Right.
It is a highly contentious, months-long, super data-heavy litigation process for literally every single patient encounter.
Which brings us to our mission for today's custom-tailored deep dive. We are looking into Waystar Holding Corp, ticker symbol WAY, to figure out how they are trying to weaponize artificial intelligence to win that exact war.
And it is a war.
It really is. So we're generating a granular strategic report on their Q1 2026 performance and their really aggressive transition into what they call an autonomous payment ecosystem.
Yeah, we've got quite the stack of sources for this one.
We do. We're pulling from the Q1 earnings transcripts, the financial slides, the SEC filings, specifically the 10Q and DF 14A plus analyst reports, and the spring 2026 Innovation Showcase press releases.
Right. And looking through all of that, you see a company at a highly lucrative but heavily scrutinized inflection point.
Yeah, the tension in the market right now regarding Waystar is just fascinating.
Because you have incredibly strong fundamental numbers competing against this very real anxiety about their near-term revenue composition.
Exactly. We're looking at a business operating the plumbing of a $2.4 trillion healthcare payment ecosystem, and they're attempting a maneuver that fundamentally alters what they sell and how they are valued.
So if you are an investor looking at healthcare infrastructure, or a tech enthusiast tracking enterprise AI, or honestly just trying to understand the macroeconomic forces reshaping hospital balance sheets, you need to grasp the mechanics of this transition.
100%. And to do that, we need to start with the product evolution itself.
Because the Waystar of 2026 is structurally very different from the old clearinghouse model of the past.
Right. The central thesis dominating their spring showcase and that whole earnings call is the deployment of what they're calling the autonomous revenue cycle. Let's unpack that.
So the autonomous revenue cycle represents a complete paradigm shift from cask-level automation to what management is referring to as Agentic AI.
Agentic AI. Okay, break that down for us.
Well, historically, revenue cycle management software, RCM, functioned basically as a diagnostic tool.
Like it just pointed out the problems.
Exactly. It was designed to highlight friction. The software would scan a batch of claims before they were sent to the insurance payer, cross-reference them against known billing rules, and just flag anomalies.
So it was basically a sophisticated spell checker.
That's a perfect analogy, yeah.
It finds the mismatched patient ID, or maybe the contradictory diagnosis code, puts a digital red line under it, and then routes it to a work queue.
Right, but who works that queue? A human. The software points out the problem, but the hospital still has to deploy expensive human capital to actually resolve the issue.
And that human capital eats directly into the provider's operating margin, which is already incredibly thin for most hospitals.
Exactly. So the transition to Agentic AI, which was specifically accelerated by their expanded Google Cloud partnership they announced back in March 2026, moves the software from insight to action.
Which is a massive leap.
Huge leap. By integrating Google Gemini large language models into their Altitude AI platform, Waystar is embedding autonomous agents directly into the workflows where decisions are actually made and dollars actually move.
So the distinction between highlighting an error and resolving it autonomously is really the whole ballgame here.
It changes everything.
Because when we look at how these Gemini models are being deployed, they aren't just crunching structured data, right? Like it's not just looking at ICD-10 codes or dates of service.
No, not at all. They are actively parsing unstructured clinical documentation.
Wow.
Yeah, so if a claim is denied by a payer because, say, they claim a procedure wasn't medically necessary, the Altitude AI agent doesn't just route that denial to a human billing specialist.
What does it do instead?
It autonomously ingests the patient's entire medical record.
Just reads the whole thing.
Right. We are talking about the AI prioritizing up to 30,000 discrete data points in a matter of seconds.
30,000. That would take a human hours to sift through.
Exactly. It reads the unstructured physician notes, the lab results, the nursing assessments. It uses advanced reasoning to understand the specific clinical justification required by that specific payer's policy, identifies the matching evidence within the chart, and then it drafts the comprehensive appeal letter entirely from scratch.
It executes all of that research and the response without any human intervention at all.
None. The human billing specialist is essentially relegated to just reviewing exceptions, rather than doing the rote manual labor of digging through dozens of PDFs.
That is incredible. And the real-world outcomes cited in the earnings materials provide a pretty stark look at the financial impact of this capability.
The numbers are wild.
Yeah. In less than a year, Altitude AI has prevented $15.5 billion in denials.
At $15.5 billion.
And furthermore, for the claims that do actually require an appeal, the AI has accelerated the generation of appeal packages by 90%.
They are literally compressing days of manual administrative work into minutes of compute time.
Which is driving what management reports as a 99% clean claim and first-pass acceptance rate.
Right, and accelerating cash flow and reducing days in accounts receivable. That is the primary metric of success for any hospital CFO.
But there's a secondary implication here, right? And perhaps a more vital strategic one, which is how this agentic AI alters Waystar's total addressable market.
Well, the TAM expansion narrative is clearly the primary focus for their institutional investors right now.
Let's dig into that, because when you sell software that merely flags errors, your ceiling is the RCM software market.
Right, which historically is about a $20 billion sandbox.
Okay, $20 billion, not bad.
No, it's a very profitable sandbox, but it is fundamentally constrained by the fact that the hospital still has to maintain an army of administrative staff to actually use the software.
They still have massive overhead.
Exactly. But the moment your software can autonomously execute the labor drafting the appeals, researching the charts, reconciling the remittances, you cross this massive economic threshold.
Because Waystar is no longer just selling a software license, they are basically acting as digital labor.
Yes. And this positions them to capture market share from the $100 billion outsourced RCM services and manual labor market.
$100 billion. So they're absorbing the value pools traditionally controlled by business process outsourcing companies, the BPOs.
Right. Think about it. If a hospital is paying an offshore BPO firm millions of dollars a year just to manually work through denial queues, Waystar can step in and argue that their Altitude AI platform can absorb that entire workload directly within the existing infrastructure layer.
So Waystar captures the software revenue and a significant portion of the displaced labor cost. That is a brilliant pivot.
It is. That structural shift from a $20 billion software TAM to a $100 billion services TAM is the exact justification for their really aggressive technological investments.
But, and I have to push back here, building an AI agent that can reliably parse medical records and basically argue with insurance companies requires an environment that you can't just spin up overnight on a public cloud instance.
Oh, completely. It requires a highly protected data moat.
Right, because the immediate skeptical response to any company claiming a revolutionary AI advantage in 2026 is to look at the barriers to entry.
Sure, because large language models are increasingly commoditized.
Exactly. A well-funded Silicon Valley startup could theoretically license a top-tier LLM and just instruct it to read medical charts.
They can try. But the reason Waystar's platform functions at this unprecedented scale and why it actually remains insulated from that kind of startup disruption is rooted in data gravity.
Data gravity. Okay, define that for us in this context.
So data gravity basically dictates that large aggregated data sets attract more applications, more services, and ultimately more data. It creates this compounding competitive advantage.
Right.
The models powering Altitude AI are only as capable as the data they are trained on, and Waystar's proprietary dataset is functionally uncatchable at this point.
Because they process, what, 7.5 billion healthcare payment transactions annually? 7.5 billion. That volume represents over $2.4 trillion in gross claims traversing their network every single year.
That is just a massive footprint, touching approximately 60% of all U.S. patients and serving 16 of the top 20 hospitals on the U.S. News Best Hospitals list.
It provides a vantage point that a nimble startup simply cannot replicate.
Because healthcare data is intensely siloed, right? And fiercely protected, by iPayer and proprietary vendor agreements.
Exactly. You can't just scrape the internet to train a healthcare RCM model. You have to literally own the pipes.
And owning those pipes enables what Waystar calls the closed-loop flywheel. Let's talk about that flywheel effect.
Yeah, so because they sit at the intersection of the providers and the payers, they have real-time visibility into the entire life cycle of a claim.
Which is critical because a static AI model trained on historical data would degrade really quickly, right?
Oh, incredibly fast, because payer behavior is dynamic. Insurance companies constantly update their adjudication rules, and often they do it without any clear public notification. Sneaky. So give us an example of how that plays out.
Okay, let's say a major national payer quietly adjusts its criteria for approving a specific class of cardiac imaging on a Monday,
Okay.
and they start denying claims that would have absolutely been approved the week prior. A startup's historical model wouldn't know about that change.
Right. The startup's software would just continue to flag those claims as clean, resulting in a huge wave of back-end denials for the hospital.
Exactly. Conversely, Waystar system detects that subtle shift in denial patterns immediately across thousands of providers on its network.
So the Gemini models ingest those downstream denials, analyze the newly required clinical context, and basically self-correct on the fly.
Yes. By Tuesday morning, the learnings are applied upstream to the pre-bill anomaly detection and prior authorization modules.
Wow, so the system autonomously prevents the newly discovered error from occurring for the rest of the network going forward.
Right. It is a continuously compounding, self-healing ecosystem operating at a true hyperscale.
The velocity of that flywheel is seriously impressive. But the sources we reviewed indicate the moat actually goes deeper than just transaction volume.
It does. The continued emphasis in the transcripts on, quote, financial and clinical intelligence points directly to the strategic weight of their Iodine software acquisition.
Right, because processing 7.5 billion financial transactions gives you incredible visibility into the claims data, like the billing codes, the billed amounts, the routing info.
It tells you what the hospital is asking for.
But it doesn't necessarily tell you what actually happened in the examination room with the patient.
Bingo. And that disconnect between the financial claim and the clinical reality is the primary attack vector used by insurance payers to justify claim denials.
Explain how that works practically.
Sure. If the hospital bills for a complex, high-acuity inpatient stay, but the available clinical documentation only really supports a moderate acuity observation stay, the payer will just deny the claim based on a lack of medical necessity or incorrect coding.
Makes sense from their perspective. So prior to the Iodine acquisition, Waystar functioned primarily as just a financial clearinghouse.
Right. They managed the routing of the claim, but they lacked deep native visibility into the raw clinical truth supporting it.
And Iodine's software bridges that exact gap.
Perfectly. They cover 1 in 3 U.S. hospital discharges and specialize in what's called clinical documentation improvement, or CDI.
So by integrating Iodine's clinical intelligence with Waystar's financial data, they achieved a convergence that fundamentally alters the balance of power between the providers and the payers.
Because the Altitude AI agents now have simultaneous access to the financial request and the clinical reality.
So before a claim even leaves the hospital's network, the AI cross-references the build codes against the unstructured physician notes and the lab values.
Right. And if it detects a discrepancy, say a physician noted symptoms of severe malnutrition, but the coder failed to capture that specific complication in the final billing codes, the system autonomously queries the physician to update the documentation.
Oh, wow. So it ensures the hospital captures the appropriate reimbursement for the actual acuity of care provided.
Exactly. It's basically fortifying the claim with clinical armor before it ever faces the payer's adjudication algorithms.
Clinical armor, I like that. And this exact convergence of clinical and financial data is the specific mechanism Waystar is using to attack the $40 billion silent denial problem we touched on right at the start of the deep dive.
Yes. And the concept of a silent denial or a payer recoupment is honestly one of the most opaque and frustrating mechanics in all of healthcare finance.
It sounds so sinister. Like, break down what a recoupment actually is.
It is essentially an involuntary, retroactive withdrawal against future earnings.
Okay.
So in a standard denial scenario, the payer just refuses to pay the initial claim, right? You ask for money, they say no.
Right. Pretty straightforward.
But in a recoupment scenario, the payer remits the funds for a procedure and the hospital closes the account. Done deal.
But it's not a done deal.
No. Months, or sometimes over a year later, the payer conducts a retrospective audit, determines the claim was overpaid or lacked medical necessity, and They unilaterally reclaim the money.
Unilaterally. And the insidious part is how they reclaim it, right? Because they don't just send an invoice politely asking for the money back.
Oh, definitely not. They simply deduct the recoupment amount from the next bulk remittance file they send to the hospital.
That is brutal. So a hospital might receive a $1 million electronic payment for, say, 500 different patient encounters,
Right.
but the payer has quietly deducted $50,000 from the total just to offset a disputed claim from 11 months prior.
Exactly. And untangling those bulk offsets is a complete forensic accounting nightmare.
I can imagine.
The remittance advice files are notoriously complex anyway, and payers often provide minimal documentation linking the bulk takeback to the specific historical patient account.
So hospitals are basically forced to deploy entire teams of analysts just to manually trace the recoupments.
Yep. They had to pull the archived clinical documentation, determine if the payer's retrospective audit was actually flawed, and then file an appeal.
And the labor cost of that reconciliation must be so prohibitive that hospitals frequently just throw their hands up and write off these silent denials as bad debt.
Exactly. That's where that $40 billion annual leakage across the industry comes from.
Wow. And this is where the Altitude AI-powered recoupment engine demonstrates the real tangible ROI of the clinical financial convergence.
Absolutely. Because Waystar holds both the historical financial routing data and the iodine-powered clinical documentation, the AI can automatically trace those bulk takebacks in the remittance files and instantly match them to the correct original patient accounts.
So it reconstructs the entire timeline autonomously.
It does. It analyzes the payer's justification for the retroactive takeback, uses advanced reasoning to evaluate the archive's clinical evidence, and flags the unjustified recoupments.
Which brings us to a specific anecdote in the sources. They cite an early adopter health system that deployed this engine and successfully identified and matched $32 million in hidden revenue risk.
$32 million. That is real money.
Yeah, recovering $32 million that would have otherwise just vanished into the ether of bad debt is a massive validation of the technology.
But the critical operational metric noted in that case study is that the AI engine performed the reconciliation work equivalent to approximately 13 full-time employees.
13 FTEs.
Yeah, and it reduced the overall reconciliation cycle time by 80%.
Which circles back directly to the TAM expansion we were discussing earlier. Waystar is not just providing a reporting dashboard to look at. They are physically supplying the digital labor of 13 FTEs.
Exactly. And the structural barriers preventing competitors from replicating this recoupment engine are really formidable.
Let's talk about the competition. The analyst reports specifically contrast Waystar's architecture with legacy giants like Change Healthcare, which they describe as basically an amalgamation of older systems like MDN and Relay Health.
Right. Those legacy entities grew through decades of aggressive mergers and acquisitions.
Which means
it resulted in a deeply, deeply fragmented infrastructure. They are managing a patchwork of disparate point solutions.
So the clearinghouse data sits on one legacy server architecture, the patient access data sits on another, and any clinical documentation tools they acquired exist in totally separate silos.
Exactly. They lack the unified cloud-native architecture required to actually feed a comprehensive data set into a central AI reasoning engine.
Because you cannot execute complex cross-domain AI logic if your data requires manual extraction and transformation across a dozen different legacy databases.
You just can't. The data gravity moat is completely ineffective if the data is sequestered from itself.
Right. But Waystar's cloud-native unified platform allows the Gemini models to traverse that entire clinical and financial spectrum seamlessly.
It's an architectural advantage that requires years of deliberate, ground-up engineering to achieve. It puts legacy competitors at a severe structural disadvantage.
Okay, so that data moat sounds impenetrable in theory. But when we look at the Q1 balance sheet, the cost of maintaining that moat is actively reshaping their revenue model.
Oh, absolutely.
Because a compelling narrative about AI agents and displaced FTEs is excellent for a slide deck. But institutional investors require that narrative to translate into measurable financial velocity.
And the Q1 2026 financial realities demonstrate really robust execution, honestly. It firmly places Waystar in the upper echelon of enterprise software performance metrics.
They are operating well above the Rule of 40, right?
Yes. And for those who might not track SaaS metrics daily, the Rule of 40 is a standard benchmark which dictates that a healthy SaaS company's combined revenue growth rate and profit margin should exceed 40.
And Waystar is effectively executing at the Rule of 50.
They are. The top-line growth is substantial, for a company processing trillions in claims volume,
Right, let's look at the numbers. Q1 total revenue reached $313.9 million.
which is a 22.4% year-over-year expansion.
But the true indicator of their platform's structural advantage is the profitability. Adjusted EBITDA came in at $135.4 million,
Which translates to a towering 43% margin.
achieving a 43% margin while simultaneously funding the integration of cutting-edge LLMs. I mean, that requires extraordinary operating leverage.
It really does. The software economics of their provider solutions division is what drives that margin profile. The direct third-party costs associated with their core transaction processing and AI deployment are exceptionally low.
Right, because the heavy capital expenditure occurred during the initial build-out of the cloud infrastructure and implementing those proprietary models.
Exactly. Now that the platform is scaled across 30,000 clients, the marginal cost of processing an additional million transactions or deploying an Altitude AI agent to a newly onboarded health system approaches zero.
So the gross margin falls directly to the bottom line.
It just flows right through.
And that leverage generates significant liquidity, as evidenced by the $90.3 million in unlevered free cash flow for the quarter.
Right, representing a 67% conversion rate from adjusted EBITDA.
But digging deeper into the revenue composition reveals a very deliberate strategic pivot that management is actively engineering here. Waystar is abandoning the traditional 50-50 revenue split between subscription and volume-based fees.
They're aggressively pushing toward a SaaS-heavy model.
Let's break down that split, because the divergence in growth rates between the two revenue segments in Q1 is incredibly stark.
It's night and day. Subscription revenue surged 38% year-over-year to $172.2 million.
So that now represents approximately 55% of their total revenue base.
All right. Conversely, the volume-based revenue segment decelerated, growing at only 7% to reach $139.5 million, shrinking to roughly 45% of the total.
And the primary catalyst for that 38% surge in subscription revenue points directly back to what we were talking about earlier, the Iodine software acquisition.
CFO Steve Oreskovich explicitly noted during the earnings call that Iodine's clinical intelligence platform is almost entirely subscription-based.
Which means they deploy these solutions on a fixed, per-provider, per-month pricing model.
Exactly. Whether a hospital's physicians treat 10 patients or 100 patients in a given week, Waystar collects the exact same recurring SaaS fee.
And the valuation implications of this pivot are profound. Wall Street inherently discounts volume-based revenue because it just lacks predictability.
It's tethered to the chaotic realities of hospital foot traffic, macroeconomic utilization trends, seasonal acuity fluctuations, all of it.
It creates a volatile top line that really complicates forward earnings visibility.
But by transitioning the majority of their revenue to fixed monthly subscriptions, Waystar is insulating its financial performance from the physical volatility of the healthcare system.
It creates a durable, highly predictable revenue curve. And when you pair that SaaS predictability with their retention metrics, the enterprise valuation begins to detach from traditional healthcare IT multiples and starts aligning with top-tier cloud infrastructure valuations.
That's the goal. The sources highlight a 111% net revenue retention, or NRR, rate.
Which is huge.
In the enterprise SaaS ecosystem, an NRR above 110% is a critical indicator of platform stickiness and product-led growth.
Right, because it signifies that even if Waystar's sales teams completely stopped acquiring net new hospital clients today, their top-line revenue from the existing client base would organically grow by 11% year over year.
Driven entirely by the frictionless upselling of new modules. Once a hospital is integrated into the core clearinghouse, turning on the new AI recoupment engine or expanding the Iodine tools across new departments is just a natural progression.
And the switching costs are astronomically high, which virtually guarantees those recurring revenue streams. The strategic goal is to command the premium valuation multiples awarded to highly predictable, sticky SaaS platforms.
Right, that is the bull case.
Okay, but let's look at the bear case now. Because the friction arises because they're not a pure-play SaaS company yet.
No, they're not.
The fact that 45% of their revenue remains volume-based creates a vulnerability. The market's skepticism surrounding Waystar is entirely concentrated on this remaining exposure to transactional volatility.
Which is exactly what triggered a pretty notable negative market reaction following the Q1 print.
Yeah. Despite beating consensus estimates, delivering 22% growth, and printing 43% margins, the stock experienced a 4% slide in early May.
The market punished them precisely because that 45% volume segment dragged down their forward projections.
Management was forced to issue what analysts categorize as a guidance dip.
Right. Waystar has historically conditioned its investor base to expect consistent sequential quarter-over-quarter growth, typically in the range of 1 to 3%.
It builds a reliable step function growth model.
But during the Q1 earnings call, management guided that Q2 2026 sequential growth would flatten out to, quote, flat to 1%.
So the staircase flattened, and algorithmic trading models immediately priced in the deceleration.
To understand why the staircase flattened, we have to look really closely at three specific physical world headwinds that are suppressing that volume-based revenue segment.
And these factors illustrate exactly why management is racing to shift the model towards subscriptions. Let's go through them. The first headwind cited is severe winter weather.
Right, and I know citing the weather often sounds like a convenient excuse on an earnings call.
It really does sound like a cop-out sometimes.
But in the context of healthcare utilization, it is a massive macroeconomic variable. Q1 saw unprecedented severe winter storms across huge portions of the United States.
And when blizzards shut down transit, hospitals cancel highly lucrative elective surgeries. Elderly and immunocompromised patients delay routine clinical visits.
And a delayed visit means a delayed claim. If the transaction doesn't occur, Waystar doesn't collect the volume fee.
Makes total sense.
Furthermore, because the inherent lag in the healthcare billing cycle, it can take 30 to 60 days from the date of service for the final patient responsibility to be calculated and billed. The suppressed utilization from a late quarter snowstorm bleeds directly into the revenue recognized in the subsequent Q2 billing cycle.
So the physical weather literally intrudes on the digital ledger.
Exactly. Now, the second headwind suppressing volume revenue is deeply structural to the American insurance landscape, and that's the seasonal dynamics of high deductible health plans, or HDHPs.
Deductibles resetting.
Right. In the first quarter of the year, millions of patient deductibles reset to zero.
So patients suddenly find themselves responsible for 100% of the cost of their care until they breach their deductible threshold, which frequently exceeds several $1,000s.
And this triggers two distinct negative impacts for Waystar. First, patients who are acutely aware of their out-of-pocket exposure intentionally delay non-urgent care, which suppresses overall transactional volume right off the bat.
Sticker shock keeps them at home.
Exactly. But the second, more immediate impact hits Waystar's patient payment solutions segment, which constitutes a really meaningful portion of their volume business.
Why is that?
Well, think about it. Collecting a $5,000 out-of-pocket deductible directly from a patient is exponentially more difficult and yields a significantly higher rate of bad debt than collecting that same $5,000 from a commercial insurance payer like Aetna or Cigna.
That makes sense. The friction of the deductible reset strains the efficiency of the patient billing workflow in the first half of the year.
Exactly. Which brings us to the third headwind, which is arguably the most nuanced and fascinating from an accounting perspective.
The accelerated digital statement shift.
Right. So Waystar powers the financial engagement tools that hospitals use to bill patients. And there is but sending an automated SMS text message costs fractions of a cent. Waystar charges a significantly lower top-line fee for the digital transaction.
So as massive health systems rapidly flip their patient populations from paper to digital, the total number of transactions might remain flat or even grow, but the gross revenue recognized by Waystar per transaction plummets.
Precisely. Management was meticulous in explaining that this shift is entirely, quote, margin neutral.
Meaning the cost of goods sold drops in exact tandem with the top-line fee reduction.
Yes, so the absolute dollar profit generated per statement remains completely stable.
The bottom line is protected, but the optics of the top line suffer.
And Wall Street analysts and algorithmic trading models often fixate on top-line revenue growth as the primary proxy for platform momentum.
So when they see sequential growth flattening, even if it is driven by a margin-neutral transition from low-margin paper to high-margin digital, the immediate reaction is multiple compression.
The market misinterprets an efficiency upgrade as a demand shortfall.
Wow. So these three headwinds, the weather, the deductibles, and the digital statement shift, they perfectly encapsulate what we can call the volume penalty.
That's a great way to phrase it. As long as nearly half of their business remains tethered to the chaotic reality of physical healthcare encounters and legacy paper processes, they will struggle to achieve the valuation multiples of a pure cloud infrastructure player.
And in addition to the volume penalty, the balance sheet carries structural leverage that definitely warrants our
The
analysis.
debt load.
Yeah, the aggressive acquisition strategy, primarily the massive premium paid for iodine software to secure that clinical data moat, was really capital intensive.
The SEC filings note that following these transactions, the company carries an adjusted net leverage ratio of approximately 3.5x, with roughly $1.5 billion in total debt.
Right, and when analyzing their asset composition, 92% of their total assets are classified as goodwill and intangible assets.
Which basically reflects the premium they paid over the book value of the acquired entities.
While a 3.5x leverage ratio is a meaningful debt burden, it really has to be contextualized against their cash generation capacity, right?
Oh, absolutely. That $90.3 million in unlevered free cash flow generated in a single quarter provides a very clear deleveraging glide path.
They are not burning cash to sustain operations. They are generating massive surpluses that can be systematically deployed to service and retire the debt facility, provided the core business remains stable.
The risk profile is completely manageable, but it does require flawless execution on the integration of those acquired clinical assets.
Synthesizing the financial realities, the risk factors, and the technological leaps we have explored today, a really coherent strategic verdict starts to emerge. Waystar is actively positioning itself to become the indispensable foundational infrastructure layer of healthcare finance.
They are attempting to become the NVIDIA of RCM.
The NVIDIA of RCM. I love that analogy. Explain that for the listener.
So, just as the global generative AI revolution requires highly specialized hardware NVIDIA's GPUs to process massive parallel workloads, the healthcare AI revolution requires an equally specialized, unified data environment.
Because you cannot run advanced agentic AI on fragmented, siloed legacy architecture.
Exactly. If an LLM attempts to reconcile a claim using incomplete clinical context isolated on an antiquated server, it will hallucinate. Or it will simply fail to identify the clinical justification required to overturn a denial.
But Waystar's scale of 7.5 billion annual transactions, merged with the real-time clinical documentation from iodine, creates the only operational environment where healthcare AI can actually function safely and accurately at scale.
They have built the specialized infrastructure required to run the algorithms. If a hospital intends to survive the crushing operating margin pressures of the next decade, relying on manual labor to fight insurance denials is mathematically impossible.
They have to adopt autonomous systems.
They have to. Waystar's thesis is that their platform possesses the uncacheable data gravity and the closed-loop learning required to actually deliver that autonomous revenue cycle.
And the short-term volume headwinds driving the guidance dip are really just transient. The snow will melt, the deductibles will be met, and the digital statement shift will eventually baseline.
But the structural advantage of their integrated AI data moat is permanent.
Yeah.
By successfully shifting the model from software licensing to autonomous labor replacement, they are unlocking access to a $100 billion services market that legacy clearinghouses simply cannot touch.
It's a huge play. But before we conclude this report, the deployment of this technology raises a massive systemic implication for the future of the industry that we really need to consider.
Let's hear it.
We have spent this entire deep dive analyzing how Waystar's Altitude AI agents fight on behalf of the providers, the hospitals, right? The AI autonomously ingests the charts, drafts the appeals, traces the recoupments, and recovers billions of dollars from the insurance payers.
They're heavily arming the provider side of the economic equation.
Exactly. But the payers, the massive, highly capitalized managed care organizations, they are not going to sit idle while provider AIs autonomously extract billions of dollars from their reserves.
Oh, definitely not.
If Waystar has deployed an agent that can read a 30,000 data point medical chart in seconds to find the clinical truth that forces a payment, the insurance companies are inevitably going to deploy counter agents that can read that exact same chart in milliseconds to find the microscopic policy-level loophole required to automatically deny it.
It completely guarantees an algorithmic arms race. The friction of the revenue cycle is being abstracted away from human billing specialists and just handed over to competing large language models.
We are heading toward a paradigm where healthcare billing is no longer an administrative process managed by humans at all. It will be an invisible hyperscale war between provider AIs and payer AIs.
These autonomous systems will argue with each other in milliseconds, litigating medical necessity and policy adherence over billions of dollars in the background of the healthcare system.
And in that scenario, Waystar's data moat positions them as the ultimate arms dealer for the providers.
If the entire ecosystem becomes autonomous, the victor is not the institution with the largest administrative headcount. The victor is the platform possessing the deepest, most comprehensive, and most unified data set.
Waystar is aggressively betting its entire capital structure and technological roadmap that its closed-loop flywheel will be the dataset that wins that war.
It is a profound transition that proves the underlying plumbing of the healthcare economy is fundamentally driving the future of the industry.
Risk defined, portfolio protected.